Welcome back to the channel, Abhay. I am super excited to have you on today because we're going over something that is extremely valuable for potential clients, but also our pre-existing ones. This is something that I myself am overly excited about because I'm actually going to dedicate $10,000 specifically just to bring our audience back on another journey, just like I did with the Fed bot. So I think that kind of gave it away here. I mentioned the Fed bot. Here we are talking about another product. Today I want to dive into what that actually looks like and what your role is when it comes to bringing a new product to market.
Yeah, for sure. Excited to be on, and thanks for having me back.
Sounds good. So a couple things that I want to know is how long did this take to be able to get brought to market?
Yeah, this algorithm has been 9 months in the making now. So it's been a little while, but we're excited to finally release it.
Well, I like that it's been a little while because that means that clearly you guys did your due diligence and making sure that all possible things could have happened and you guys are able to fix that for it to be public.
Like we had started working on the idea longer than that even, but the actual coding started and optimization started 9 months ago.
Nice. Wow.
So a fair bit of rigorous testing on it too.
So I want to know, what's the high level thinking of the strategy when it goes into making a product like this?
Yeah, so with this strategy, it is a little bit different to some of our other strategies, but they're all unique in their own way. But with this one, it's a scalping strategy within a higher time frame trend. So we're looking at the higher time frame trend and figuring out how strong really the trend is and where it's going. So if you think about the higher time frame is, let's say, bullish, and then we look at the lower time frames for an optimal entry. So if we find a mean reversion opportunity in the lower time frames where potentially that pair is oversold, well, we know, okay, in the lower time frames it's oversold, but on the higher time frames, the trend is to the upside, so we can take a long trade with confidence.
Nice.
That's the high level thinking. I mean, to put it in an analogy, if you want to swim in the ocean and the current's going a certain way, and you want to flow with the current rather than swim against the current, so it's all about when to jump in, flow with the current, and then jump out.
Nice.
Before it changes.
And how much does that differ from the Fed bot, would you say?
I would say it does differ quite a bit because with the Fed, traditionally what we've seen, the focus has been more on the risk management sequence, whereas on this, the focus has been more on just optimal entries and exits. That's why we haven't had to scale in to ideas as much as we see on the Fed, and hence why we're able to create a low drawdown variant of this strategy where our objective is to keep the drawdown under 10%, and for the vast majority of time in our back testing, except for outlier events, we have managed to achieve that.
So would you say that this is actually a little bit more risk adverse than the Fed bot, or it really just depends on how you set it up?
Yeah, so that's a great question. We've actually done something different this time. We've created a base strategy, and then we've created two variants from it. So this variant that we released last week to the program is the low drawdown variant, where the primary objective is to keep the drawdown of the account low, sub 10%, with a very consistent profit. But naturally, the profit won't be as high as, we're not aiming for 25% months on this variant. Now we're using the same base strategy. We're creating a different set of optimizations and a different variant called high profit, where the primary objective is profit, even though it can go into more drawdown. And that one is about, I would say, 3 months away. We're still working on it, but that's going to be coming out a bit later as well. But the idea is that the base strategy is the same. And from that strategy, we've created two separate variants with two very different objectives.
Wow, nice. So I want to ask you, and this is going to be a bit of a personal opinion, or maybe there's stats to back this. Which one would you rather run? If you cannot run both, what ATA product would you pick? Would it be the Fed bot or this new product, which we haven't even mentioned the name yet? So maybe we could let the people know what the name is. But what would you say is your most sought after product?
Just like anyone loves their children, I like them all equally. But I think depends on the objective. So if I was more risk averse, then I would pick Dalio low drawdown. If I was willing to take more risk, then I would run the Fed. Because like I said, the Fed, especially if we compare it to the low drawdown variant of Dalio, the Fed will have higher drawdown, but it also has the higher potential for bigger returns. Whereas here, our objective has been first and foremost to keep the drawdown low. And that's also because it's designed for a different type of trader. Our strategies right now that we've had prior to Dalio have all been focused on high profit, but they all tend to have instances of higher drawdown. Whereas this one is because it's focused on low drawdown, it's designed for traders traditionally with bigger accounts who don't want to take as much risk and they want consistent return while not having to check their account as regularly for drawdown as well. And we've put extra risk measures in as well to protect against outlier events.
Speaking of outlier events, this you probably will not have the specific exact answer to this, or maybe you do. When it comes to outliers, typically in backtesting they would arise. I'm assuming you never know what could happen in the future, but how long does that phase of backtesting typically run to where you're like, okay, this is proven X, or whatever is X is for you?
Yeah, so we so far have focused on the last 3 years. In this strategy, we've actually gone back the last 5 years. And for future ones, we are getting more reliable data for going back 10 years as well.
Wow.
But in this back testing with Dalio low drawdown variant, we in the last 3 years did not exceed more than 10% drawdown. And in the 5-year test in 2019, there was an outlier event where the account experienced much more drawdown, but that's where we've got equity protection in the account. And we generally set it at 15 to 20% is what our guideline is for clients. So what that means is if you have unrealized loss of 15 or 20% on the account from its equity high, then it would realize the loss and it would close the positions to protect the account. So even though the back testing showed that in 2019, there was an instance where the drawdown exceeded 20%, but with this protection mechanism, if clients have it enabled, which we do by default, then they wouldn't have actually experienced that drawdown. And the idea there is that, let's say you do take a 15% hit on the account once in 5 years. Well, if it's still doing, hypothetically speaking, 5 to 8% a month, it's not a big issue at all.
I liked how you said equity protection. I'm assuming it's pretty much the same thing as a stop loss, or am I incorrect there?
Yeah, it's essentially just a basket stop loss. So it's
Okay.
a stop loss on the whole account rather than any individual trade or pair.
Oh, very interesting. And you said a lot of things there. In fact, so there's been a lot of confusion around drawdowns. I've had quite a bit of clients reach out, or not, I would say potential clients, people that are interested, and they don't quite understand drawdowns. And I love how you actually were able to articulate that understanding of a drawdown, how it's unrealized to realized. And the realization only happens when you close the positions. Another question that I'm curious about is, we have the Fed bot, the Gold Digger, we have the Yellen, and we have the Dalio now. What else are we adding to the basket of products that we're going to have, and why are we continuously looking to add more?
Yeah, that's a great question. Actually, before I even jump into that, one more point on the drawdown is the way we design these algorithms. We have a risk management sequence, and the risk management sequence scales into ideas. Now, with that, if the equity protection is not enabled on the account still recovered. So in 2019, like I was saying, if the client didn't have equity protection, they would have experienced 40-50% drawdown on the account unrealized, but then realized loss was zero. The account recovered because it scaled, the risk management sequence scaled into the idea. But if they want to protect against having that much risk on the account, then they can. And that equity protection just makes sure that you don't even have more than 15% unrealized if they set it at 15%, which clients have the discretion.
Okay, so let's put the question of products on the shelf for just a moment here because I want to unpack this just for like one more minute. So let's say,
Yeah.
all right, a traditional stop loss, let's say there's a wick, a massive spike, and it would hit wherever you have the stop loss set. In the way that we have it set up, is that typically the same thing here? Because you said it doesn't close out an individual trade, but let's say there's a pair that does have a wick and maybe it does a spike of 10-15%, where in the event, would it close out all the other trades as well, even though they may not be the reason as to why that spike has occurred?
Yeah, so this is on this strategy, we've kept it account level because, like I said, majority of the time we didn't exceed 10% drawdown anyway, and we gave a little bit more room to set our guidelines at 15%. But the client can actually choose to set it at 30% if they want. It's up to them. But this is at the account level. So what that means is, let's say you have 100,000 in the account, and the account experiences drawdowns, so unrealized loss, and you've set it at 15%. Well, when the equity of the account, which is unrealized, hits 85,000, it will close the trades to protect the account. But the idea there is that you never experience more than that 15% drawdown. It's just ultimate protection. Whereas if clients were okay to take a little bit more risk and they said, I don't really want that protection, then that's up to them. In that case, what would happen is they might experience higher unrealized drawdown, but then the risk management sequence tends to recover. But it's just there as extra protection so that you never, if you do have it enabled, you never run into the situation where you completely blow the account, no matter what happens in the market. You know, that's the idea behind it.
Yeah, it's like it's an insurance to a degree. Okay,
Yeah.
so let's circle back on this product question. So the question essentially was, why are we continuing to build more and more products, in essence, and what other products do we have in the pipeline?
Yeah, so in terms of other products, the two algorithms that we're most focused on, and again, it would depend on whether we take them forward, on how testing goes as well. But the two that we are right now most focused on is Dalio High Profit, which is the other variant of this same strategy. And the next one after that is a crypto algorithm for BTC and Ethereum.
Nice.
That's just to give extra diversification into another asset class.
Nice. Wow. And I want to ask you something about the Dalio bot. If you had to say your favorite attribute of this software, just the Dalio, what would that be? Like, what's something that comes to mind?
Yeah, so something unique about this one is, for the first time in our strategies, we've actually implemented a concept called hedging. And what that does is it allows multiple risk management sequences to run concurrently on the same pair in opposite direction. And in that time where they are running, let's say you've got a long sequence and a short sequence running concurrently, a lot of the positions tend to hedge each other out, and it keeps the drawdown quite low. So that's something unique, and it's difficult to execute because you have to track multiple sequences. So we're quite happy that we've been able to achieve that.
Yeah, it's tricky when you're taking two positions on the same exact asset. One of them's got to be right.
Yeah.
Wow.
Yeah, so it will basically set two take profits, and then one of the take profits will hit, but the other risk management sequence will continue to strategically scale, and then eventually that will close out in profit as well.
Wow.
So you've basically benefited from both directions.
Nice. Amazing. So I myself, from running the Fed bot, I've done so far over 3,000 trades. It's been running for, I'd say, shy of 6 months right now. Maybe I'm off like a week or two, but over 3,000 trades. Would you say the trade frequency is around the same with the Dalio as it is with the Fed?
It is a little bit lower on Dalio. We get about, in our testing so far, about 250 to 300 trades per month. I would say with the low drawdown variant, it's generally a little bit lower because it doesn't scale as aggressively into ideas. And yeah, you could say on the lower end, perhaps 150, and on the higher end, 300 per month.
Oh, nice. Okay. And then also for my Fed bot, again, maybe the data's changed by the time someone has watched this, but my profit factor is 1.84. What could I possibly expect? Of course, nothing's guaranteed. What could I possibly expect with profit factor in the Dalio?
Yeah, that's a great question. Actually, in our back test, this has produced the highest profit factor across our strategies. And in some of the test accounts that we're running, which they only have limited history right now, 4 to 5 months, but the profit factor has been higher. So higher than 3 in some of my accounts that I'm testing with. Yeah.
That's far greater than what I have on the FedBot. Wow.
Yeah.
Okay, so another thing that I was actually curious and I wanted to know, again, I'm making a lot of these analogies or comparisons to the FedBot because that's the only experience I have with the softwares. My FedBot is done over 3,000 trades. It is profit factor of 1.8, but I've noticed it trades all currencies, correct? I want to know if the difference on the Dalio is the same on the FedBot in terms of all the currencies. And you know how when you're looking at all currencies, some are not as profitable as others. Do you see a difference in the currency profitabilities, or are they typically the same? Like for instance, let's say Aussie franc is not a good performer for my FedBot. Would that translate over to the Dalio?
Yeah, that's a good question. Not exactly the same currency will translate over because the strategy is different. And also with this strategy specifically, because we're creating 2 variants of it with different objectives, the optimization has been quite heavy and quite mature, I would say, in how we've done it. So with the low drawdown version, which we released last week, we actually deeply analyzed 30 different pairs. And then we created a basket of the best 15, which have produced consistent price action and kept the drawdown low. So we specifically chose the 15 that keep the drawdown low. And then that was the first layer of, you could say, optimization. And then the second layer is each pair has its settings set differently. So even down to things like whether the pair has hedging enabled or not, whether the pair has trailing stop losses or not, how the risk management scales into the trade is also different. And the take profits are also optimized to each pair based on its historical performance and how the pair behaves. So it's heavily, heavily optimized.
Wow. Okay. Wow. Well, I think that's everything that I wanted to know about the Dalio bot. But for the people watching, if there's something that they want to know about the Dalio bot, they could leave a comment below. And I'm sure you'd be up to answer some questions that come in on this specific product for another one of these.
Yeah, 100%. And I don't think I answered your last question on why we keep creating new ones.
Oh, yeah, of course.
Yeah, effectively because we want to create a diversified offering for clients, for investors, for ourselves as well, because we put a lot of our own capital in. And the idea there is just like you would invest into stocks or crypto, you want to be diversified within that asset class. This I treat essentially as a separate investment vehicle. So within that, diversifying across multiple strategies, multiple variants of strategies, multiple asset classes. So far we've had forex and gold. Now we're moving into crypto as well, and really create a diversified offering so that your risk is spread out across many different strategies. Because if you have, let's say, 4 Fed accounts running, well, if something happens on the same pair because you're trading the same pairs in the same way, all 4 accounts are probably going to get affected, right? So just spreading your strategy risk, spreading risk across brokers and different asset classes just allows you to create a very diversified portfolio.
Yeah.
That's why we continue to add more, and that's why we continue to have different objectives or strategies as well, so clients can choose which ones suit their trading style and risk preference. That's why, like I was saying, some of the ones we've had are focused on high profit, whereas this one we focused on low drawdown because it suits a different type of trader.
Nice. And that makes complete sense. Of course, you want a diverse portfolio. It helps mitigate risk. And to your point, you just nailed it perfectly. If you have 10 Fed bots running, guess what happens if the Fed bot runs into some type of complication? All those 10 licenses would potentially experience the same thing. So it makes sense.
Exactly.
Yeah. Well, thank you again for your time. I want to just go ahead and plug, guys, ask us questions, please. We would love to answer whatever curious minds you have revolved around our products or this specific product. And I will make sure that we can get Abhay back on, and he's the one who actually is the brains that helps bring it to life when finding the strategy. And if you haven't watched our first interview, you can hit this right up above and go ahead and watch that, where we actually dove into quite interesting things revolved around the Fed bot. But any final words you'd like to give to the audience before we sign off?
I would say just take the opportunity seriously, because I've looked each and every corner of the market, and this is the closest to, I would say, automated income, to put it lightly, that I've found.
Yeah.
Because it is a serious opportunity. I mean, trading generally in the marketplace, but being able to set it up in a way where it's mostly hands-off is obviously can be extremely lucrative. So I would say take the opportunity seriously, and just, thanks for having me, Matt. Potentially next session we could do a Q&A.
Yeah.
Based on the questions that come in.
Yeah, definitely. That'd be great. So I'm just going to keep telling them to leave questions for us. Yeah. And you guys heard him. This is not financial advice. There's no such thing as passive income, but there are things that come very close to passive. And this is the best thing that I found, and he just said this is probably the best thing that he's found, and he's searched far and wide for something like this. So much so he helped build it.
Yeah.
Well, thank you again, brother. I'll talk to you on the next episode.
Thanks, Matt. Take care.
Bye.